Hey, fantastic fam. Welcome to our community where we combine the woo and the work. We are two professional women who believe we can have it all and constantly upgrade ourselves to meet our visions. I'm Kalyani and I've chosen the off-roading path to personal development, being an entrepreneur with the journey of motherhood. I'm an economics postgraduate and I love working with all things mind and money. I've founded and sold one business and I'm now building this business that feels like fun and freedom for life.
Hi, I'm Rupali. I'm a numbers nerd turned Reiki master and many other things. I found a passion for all things wellness. I've worked in banking and finance for 15 years and I love combining that knowledge with all things energetics to create impact in a fun, easy way for others. Join us as we share the behind the scenes of us creating wealth, freedom and magic.
If you've ever looked at a chart, you might see that you'll need to kind of spend some time on charts to be able to notice this. But you'll see that every time there is a level that is approaching a multiple of 10, 50, 100 or 1,000, there tends to be a lot of accumulation around that level, meaning that it takes time for the candlesticks or the chart or the price, whatever you tend to focus on. It takes some time for this price to break above these multiples of round numbers or multiples of 10, let's simply put it as that. Why is this? Let's discuss a little bit about this in detail. This is because of a phenomenon called psychological levels. Psychological levels play as resistance or accumulation happening around round numbers being multiples of, like I said, 10, 50, 100 and 1,000. In some charts, they could also be multiples of 5. And these resistance levels basically show us the simplicity of mass psychology when it plays out on such a large scale. Many times we tend to complicate stock markets a lot. We tend to kind of put so many algorithms and complex formulae into it. But it's simply mass psychology at its finest. And when it's mass psychology, it's very different to an individual person's thinking. Mass psychology, fortunately or not, tends to lean a lot into herd mentality. If you've seen a herd of sheep act versus one sheep which tends to be a lot more intelligent as an individual being, a herd of sheep would kind of, roll in together, roll out together, and it's very much about not missing out. It's very much about keeping with the herd, staying together and acting on the basis of that. This plays a lot into the stock markets, and psychological levels or round figures are a reflection of this. When I talk about big money or money makers in the markets kind of making the big moves, they also tend to place their bets on the basis of these round numbers. So let's say if they have a long trade, meaning a bullish trade, meaning a trade that is hoping to go up, that they're hoping for being profitable as going upwards. If, let's say, they place the trade at 5,177, their target, quite simply, could be 6,000 or 5,500. So it does tend to be quite simplistic in that sense, which is why round numbers play a big role. And this is also why you'll see resistance around these round numbers. Now, this resistance happens because the big money or retail investors as well, when they see these round numbers approaching, there's a sense of a psychological contentment or arriving at their target levels psychologically, where once they see 5,500 or 6,000 being realized, the rounder the number or the bigger the multiple of 10 it is, the bigger the satisfaction. The satisfaction that you receive by arriving at a 5,200 versus the 5,500 versus the 6,000 is increasing in order of the numbers that I just mentioned. So let's say if the market is at 6,000, which is exactly where it's seeing some resistance as I record this in November 2024, that is a number at which a lot of the big trades are being closed off at, because it's seen as a number that is going to fulfill a lot of the targets. It's going to fulfill that psychological feeling of contentment, of satisfaction, of having reached a target. And once these trades are being closed at that level, that means that the supply of the stocks becomes higher at that level than the demand, which brings the prices down. Yes, I hope everyone is following me. This is Economics 101. When the supply is in excess of the demand, the prices come down. When the prices come down, it has currently, for example, I'm looking at the SPX chart exactly right now while recording this. It reached 6,000 between the dates of 8th of November and 14th of November. And then on the 15th of November, it fell down to the levels of 5,800. Plus or minus a few percentage points, and then it has kind of stayed around that level. Now it needs an extra push to go back up to the level of 6,000, and I'm quite convinced that in the midterm, let's say a few weeks, it is definitely going to reach up to the level of 6,000, but this will be on the back of new trades that are placed with the confidence in the market that the market is going to carry on going up. So this is going to need a whole new pattern of mass psychology kicking in, where people have profited from the previous cycle. They have exited their trades at 6,000. The market has come down as a result of excess supply. And now people have again found confidence in the markets, and they're going to start placing their bets again, which means the demand will be in excess of the supply, which drives the price upwards. And with this buoyancy, it needs a big push to go past the level of 6,000. Once it goes past the level of 6,000, at this point, it will be termed as retesting a resistance level. Previously, it touched the 6,000 level, which was the resistance level, and then it came down. Now with this new cycle, if it surges past the level of 6,000, then that will be considered as a very bullish sign, because it has retested this resistance level, and that level did not offer resistance. It did not offer enough resistance to keep the price below. So this is kind of what we're looking at. This is one of the things that we're looking at. I don't trade on the basis of this. My clients don't trade on the basis of this. I'm just explaining common phenomenon that we see playing out in charts and in the markets, and making sense of it for a wide audience that we have on this podcast. Going back to the numbers now, let's say that we are at 5,800 right now, and the new cycle does not start with the confidence that we just spoke about. It does not start with that newfound reassurance, confidence in the market for it to carry on going up. Then we will see a downwards move, simply playing out as people or big money seeing that there isn't a lot of confidence in the market is looking weak. This very much plays out on the perception of how they see the market doing, on the perception of the sentiment around the market. So if one big market maker kind of catches whiff of weakness in the market, and then they place a big sell order, that drives the market down, and then kind of herd mentality starts playing into it, driving the market further down. We could see a further downward move, which is called a correction in the short term. And when it is up to about 20% down from its highest level, which means 20% down from 6,000, which was the previous high, 20% down of 6,000 would be 10% is 600. So 20% would be 1,200. 6,000 minus $1,200 would be 4,800. If it were to go down right up to the level of 4,800, which seems very unlikely at this point, this is when it would be termed as an official recession. Generally, though, it stays in the range of about a 10% fall, which at this point with the calculation, it would be at 5,400. So 6,000 minus 10% of that, which is 600, which is 5,400. This is all on the chart of SPX. I'm just taking that as a representation of the US markets. So 5,400, up till the level of 5,400, or even a little more than that, about 10 to 15% is the general consensus for a decline, which is considered as being very normal, and this is called as a correction, which is normal, necessary, and part of the movement upwards of a chart or the market or the stock. So if it goes down to a level which is within this 15% mark, like I said, up to about 19%, technically 20% onwards is considered as a recession, whereas anything below that is considered a correction. It is normal for the market to correct about 2 to 3 times, up to 15 to 19% in a year, and about 2 to 3 times up to 10% in a year. So if you see any of that playing out, you should not be worried, provided, this is a big condition, provided that you have done your due diligence and you're invested in fundamentally good businesses, fundamentally good companies that you're confident of going up, increasing in prices, increasing in value over the course of time. Which means that the 10%, 15%, 19% correction in the short term is literally only for the short term. It's not here to stay. It will not impact your accounts in any serious manner. So let me know if this information was useful. I'll be dropping more details and more podcasts on technical topics around this stock markets. Stay tuned and leave us a feedback if you found this helpful. We would really appreciate your feedback as reviews on the podcast app you tune in from. Support us also by sharing this podcast with 3 of your besties who would benefit from being fantastic.